everyone, welcome to Modern Thinking. Today, we are going to talk about auto loans. What is an auto loan and how does it work? Let's understand the basics of the auto buying process and what an auto loan is so we can see just how to make this work for you. So stick around and don't forget to smash that like and subscribe button for more awesome content. With that, let's get started. Hey everyone! Now, before we discuss the auto loan process, please remember that we are not a financial advisor, so the topics discussed do not constitute as financial accounting or legal advice. Understand that the topics discussed today are for entertainment and educational purposes only. With that out of the way, let's dive right in. Now, whether you are brand new to the auto buying experience or a repeat customer, buying a vehicle can be a lengthy and costly process. So what should you look into before assuming the responsibility of a loan? First, think about what you want versus what you need. At this financial stage in your life, can you comfortably afford what you want? Let's say, for example, you want a $25,000 vehicle, but realistically, you only need a reliable vehicle that costs $15,000 instead. At this point in your life, do you have that extra $10,000 to make up the difference without it affecting everything else in your life? Sure, getting behind the wheel of a new or pre-owned head-turner of a car can be exciting, but if you can't afford that luxury right now, then forget about what everyone else thinks and get yourself situated to buy that dream car of yours in the future. Car buying can be one of the most expensive purchases you make in your life, so let it work for you versus against you. Next, decide whether you want to buy or lease. Some individuals consider leasing because they don't want to have to worry too much about maintenance and they want a new or newer car every year. For example, if you're leasing a vehicle, that means the company you're leasing it from still owns it. So of course they want to make sure their vehicle is in good working condition so they can lease it out to other people when you decide you want a different car. Some individuals lease because they can usually get a lower monthly payment for a more luxurious vehicle than they could otherwise afford. If you are afraid of taking on debt, aka a loan, but you want to build your credit, then leasing can be an option for you. Now, most others purchase or finance a vehicle because they want to own it or essentially pay it off and use it for years. This is when they take on that debt, otherwise known as an auto loan. The choice is yours, but always think about your financials because more often than not, a vehicle becomes a liability more than it is an asset, meaning it can cost you more money than actually make you money. Now onto the meat of the subject. Let's give an example about Johnny. Johnny is a 19-year-old student who just started working and makes about $1,300 a month. Johnny's dream car is a brand new $40,000 Dodge Charger. But with only a $1,300 monthly income, he knows he has to be smarter with his money. Good thinking, Johnny. He starts looking at pre-owned vehicles and sees that he can afford an older and pre-owned Dodge Charger being sold at only $6,500. So he starts thinking about the following. When you obtain an auto loan from a financial institution, you receive that money in a lump sum. You then have the responsibility of paying it back with interest over a set period of time. How much you actually borrow, how long it takes you to pay off that borrowed money, and the interest rate on it is what determines your monthly payment. So with these thoughts, Johnny heads over to the auto dealership and speaks with a representative to go over the numbers. The vehicle he wants is $6,500. The loan amount will be slightly more than this amount because you have to factor in fees, down payment, and taxes. Johnny only has a 550 credit score, so his interest rate will be higher. But luckily, his mom agrees to co-sign with him for a lower interest rate. A cosign means someone with a higher credit score, usually a person with a credit score of 700 and above, agrees that they too will assume responsibility of the loan on your behalf so that you can get a smaller interest rate for the money you're borrowing. This basically gives Johnny a 4.5% interest rate versus an 11% interest rate that he would have otherwise paid on the amount he was taking out. That's a huge difference. So with the numbers down, he can finance the $6,500 vehicle with a 4.5% annual interest rate, also known as an APR, for 60 months or 5 years. Let's go over these numbers and more. Johnny puts $500 as a down payment that will reduce his original $6,500 vehicle price tag to $6,000 flat, which means he actually gets a lower monthly payment because he's borrowing less money. Now, we can go over all the math, or you can visit any websites like this shown on the screen and plug and play your numbers to get the most accurate amounts and statistics for your loan. For this example, let's continue. Johnny will now be financing a $6,000 loan instead of a $6,500 loan. We're going to factor the $6,000 loan amount with a 4.5% APR for 60 months and a 1.25% sales tax. This puts his monthly payment at $111.86. That initial $6,000 loan amount he was paying would be equal to a little over $7,000 because of interest dragged over a course of 60 months itself. Johnny is ecstatic. He knows that he can afford this without putting himself into debt. He has a reliable vehicle that he actually wants to drive, and because he's paying out on a loan, he will also be building his credit score so that when he wants to buy another car in the future, he will no longer need someone to co-sign for him. He would have built his credit score up by that point to a substantial amount. So yes, contrary to popular belief, paying off a loan can actually help you build your credit score. So to summarize, what is an auto loan? An auto loan is a contractual agreement between you and a lender where they agree to give you money to buy a vehicle as long as you agree to pay it back that money with interest. How does an auto loan work? The loan itself is easy. Pay back what you owe plus interest. The best rule of thumb is to work out the most affordable loan amount you can borrow. That means, like Johnny, what amount can you reasonably afford on your income? Then you get the lowest annual percentage rate that you can get. Shoot for 6% or lower, and then work out how much that would be every month. With this monthly amount, can you afford car insurance and gas every month as well? If so, then be happy and enjoy that vehicle of yours. If not, then look at alternatives or set yourself up in a better financial situation before you go and take on a loan that you cannot afford. The key to financial freedom is understanding liabilities versus assets. You can have everything that you want, but delayed gratification is a key concept to understand, even when it comes to purchasing a vehicle. Take the right financial steps now to help you get to where you want to end up in life. Everything is possible if you believe, and you have to put the sweat equity to get there. Thanks for watching, everyone. Be sure to leave a comment, like, and subscribe to the channel and start your journey to financial freedom today.